DLMM, everyone. Welcome to Do Your Own Research Labs podcast show. I'm your host, as always, Frank Hazard. And today we want to, not begin, but continue with the series on DeFi. Yeah, so today we just want to talk about DeFi and liquidity provision, and it will be a series. So every week we'll be doing a series on the DeFi opportunities available in the DeFi opportunities and liquidity provision opportunities available in the crypto space. So today, or rather in this series, will be with Gideon. So I'll just let him introduce himself for a short while. Then, yeah, we'll kick it off.
GM everyone. Thank you, Hazard, for this time and space. My name is Gideon. I am an on-chain data analyst and blockchain and DeFi educator. So DeFi is my business and DeFi is what I do. Specifically, what I focus on is liquidity prevention. So I guide people on liquidity prevention and helping them do liquidity provision as a service, uh, both as a trader and as a diligent. Yes. So
Yeah,
I am happy. I'm happy to be here. I'm looking forward to presenting what we have in the space and helping as much as possible in empowering people and ensuring that they get another stream of income and learn a new skill.
yeah. So just a disclaimer though, this is not financial advice. It's purely
Yeah,
for
of course.
education purposes and exploring. Remember, DeFi is risky, so whatever we are doing here is just based on our deep dive into research. Also, just request, please subscribe to our channel. Follow us on everywhere. We'll share our links on Twitter, Fakasta, on YouTube, everywhere. So Gideon, I think today you'll be more. You'll be the one who will be running the show more. I'll just be bumping in to clarify or ask a few questions. But
Okay,
yeah,
okay.
I'm really excited because first of all, how is the market to you? Because I stopped. I went on a hiatus on DeFi matters because the market has been really terrible. So why not
Okay.
we just get back into it and yeah,
Oh,
struggle with the market.
okay, so first things first, I would like to solidify on what you've said. Disclaimer: this is not financial advice. Whatever we are doing here is for educational purposes and educational purposes only. Liquidity prevention that we will be doing live or otherwise will be for fun and learning. So remember that the markets are very volatile and it might be a risky adventure if you do not grasp the skill that is needed here. So that's uh, that's the beginning of all of this. So far, the markets have been doing great. We had a really dry and complicated season, I think, for the last 1 month, but things have shown some green light actually. As much as we are not where we were looking to be, the projection while the year was beginning and when the US was electing a new president was quite humongous, but we are not there yet. Regardless of that, we are somewhere, and I believe that the worry and the fuzz that was in the market is coming to clear. And as you can see from indicators such as the greed index, things are trying to fall into place. Things are trying to fall into place. But I am a happy person because most of the assets that I'm looking at are really doing great. Are really doing great. So I believe that there is no better point to enter the markets as now. So don't feel worried that you missed out. You can still come back. You used to have quite good alphas back in the days when we were just getting in the field. So I think you can come back and solidify on that still. Yeah. So I think I can begin as our screen is showing. We've had this presentation waiting for us eagerly. And today, being an introductory part, I believed to just introduce people into what DeFi is majorly concerned with. So, DeFi being a decentralized finance, uh, we do not look we do not look to be governed by the normal entities that govern other financial markets. In DeFi, it is for the people and by the people to govern everything. The workings are more so same as in the local or in the traditional finance, but they have been modified. So, for example, in the traditional finance, you will want to have the ability to swap one asset into other. But in DeFi, it's still the same concept. But now, the ability to swap one token to another is majorly enabled by the people using a particular DeFi protocol to ensure that there is that liquidity of helping people to swap one token to another. So, that being said, I believe and I wanted us to begin by understanding what automated market making is, that is the AMM in DeFi, what it does, how it has helped DeFi to grow, some of the advantages and disadvantages, and also look at the evolution of AMM throughout time because there have been changes that have been of a very positive effect. Mm, So, interest technology that powers all, if not most, no, most, if not all, DeFi protocols in the space. So, as the name suggests, it is market making that is automated, not entirely governed, not 100% governed, but it is automated in a way that they use mathematical formulas to ensure that there is an equal balance of crypto assets that are being swapped without the need of having the traditional order books or the centralized order matching that is in centralized exchange such as Binance and OKX. So that being said, you have to get the idea of having these two people who don't know each other, but they need to have the ability of swapping their crypto assets if they are using decentralized protocols that do not rely on the traditional order books and centralized order matching. Uh, AMM, of course, AMM has had its role, and it is primarily a crucial role. Without AMM, then we will not be having the ability of swapping tokens. Or if we had the ability, it means that the ability will need to be centralized. And since this is a decentralized space, we do not want centralization. We want to run away from that. So the fact that we have AMM is majorly what is driving DeFi. Without that, I believe that DeFi will not be functioning. The trading will not be there. The flow of capital across different crypto assets will not be there. The flow of money and assets between different DeFi protocols will not be there without AMM. They have basically AMMs have basically become the backbone of decentralized exchange and other DeFi protocols that tend or look to utilize that technology. On the other part, we have had the evolution, we have had the growth of AMM from one point to another. And before I start getting into that, I don't know if thus far, Hazard, you have something to say or something to ask.
No, no. Maybe just we use an analogy for people who are super new to AMMs and stuff. So when we what we mean by automated market makers are they just people who are enabling. Um, Let me just use an example. For instance, Gideon wants USDT and he has maybe ETH, for instance, or Solana. So I, as a market maker, maybe I have like a very large reservation of both USDT and Solana just lying somewhere. So what I do, I just put it out there in the smart contract that is governing that. That's why it's called automated. So now I don't want to call it platform. Maybe let me use the protocol that is enabling AMMing happen. Will use my assets to satisfy what Gideon wanted. Maybe he wanted to swap his USDC for coin X. So me, who has like a large reservation lying somewhere, I just put it out there so that it can be used by the protocol of the technology. Yeah. Then
Yeah,
now. Mhm.
yeah, sure. You've just expounded and explained it in a more better terms. So the liquidity providers are the people who will bring their money into liquidity, uh, no, into an automated market making protocol to ensure that their money facilitates the trades to happen within different parties and with the different assets. So as Hazard has said, if you have a good amount of money that you want to put it there that you're not using, but you need it to work for you, so as a liquidity provider you will come provide that asset or those assets as liquidity to these protocols, and then the protocols will have a mechanism of incentivization. So the protocol will just say,
Mm.
for the people bringing us money, for the people providing liquidity. So that is basically they're giving the protocol money to use. We will give this and this percentage of the transactional fees. So you're looking at earning those fees while still retaining the ability of controlling your money within these protocols. But of course, we will get into that later and try and figure out how these protocols maintain the mechanism, and what will happen. Let's say what will happen if you only have one asset to provide liquidity for. What might be the repercussions of providing liquidity to protocols, and some of the things. So thank you, Hazard, for expounding on that. Um, Automated market making has had its growth. It was not always as easy as it is right now. It was not always as seamless as it is right now. It has gone through a certain path of growth. In automated market making or liquidity prevention, you will mostly come across these two terms. The first term is concentrated liquidity market making and dynamic liquidity market making. But you have to realize that both the terms describe different uh, different mechanisms of providing liquidity. So, regardless of them being concentrated or dynamic, they all base down to one thing: ensuring automated market making and ensuring distributed liquidity provision. So this transition between the initial concentrated liquidity market making, that is CLMM, to liquidity, to dynamic liquidity market making, that is a DLMM, has led to improved capital, increased flexibility, and we will look at these factors deeper as the series continue, and has provided a better or seamless experience in DeFi trading and liquidity provision. So the transition from CLMM to DLMM has actually been of an advantage more of a disadvantage. But of course, we will look at the advantages and disadvantages of these two mechanisms and and uh, try and get deeper into why this is happening and why you should choose this over this, and the conditions that might push you to choose one mechanism over the other. So those are some of the things that we'll look at, and we'll progress digging deeper as we jump more into the series. So the comparison between CLMM and the DLMM is basically focused on how how the price or how the liquidity is being distributed within a price range. So initially, or the basic working structure of CLMM is when you provide liquidity, when you give your money into these liquidity provision protocols, your money will just be allocated to a fixed price range. So if let's say an asset is at a hundred price, it will stay. Your money will stay at a specific price range. It is not adaptable to the changing market conditions. So if you provide liquidity to an asset, let's say you provide liquidity to Solana at 120, if the market conditions change in CLMM, then your money will not be adapting to those market changes. Your money will just be limited to that specific fixed price range. Okay, the flexibility of adapting to market conditions is very, very low. In some places it's not there at all, and you'll not even realize that now the market conditions have changed and your money is not working for you. That is basically how CLMM works. If the market conditions changed, then your money will just be there. It's not working for you. And as a liquidity provider, what you're looking for is your money working for you consistently within different market conditions. So after CLM, we had DLMM, which is more of an advancement from CLM. In DLMM, now your money is allocated basically on how the market is behaving. So if if at any point the market conditions changed and you have been providing your liquidity in a dynamic liquidity matchmaking uh, kind of a mechanism, then your money will be adapting to how the markets will be changing. So as compared to when CLMM, your money was just in a fixed price range. In DLMM, we cannot we cannot have your money in a specific price range. It will always be changing with how the market conditions are changing. So you can already differentiate, like, if I want this money to be active in this price or in this fixed price range, I will go to CLLM. But if I want my money to be working within the market changing conditions, then I will need DLMM. And and with that, you can actually have the advantages and the disadvantages of each mechanism. So for CLMM, these are some of the advantages that came with it. And I believe that some protocols still utilize CLMM. I'm not saying it's bad. I'm not saying that it's not the best approach. I'm just saying that if you're looking to be more rampant, if you're looking to be more active, then you will want to have an option other than providing your liquidity in a static kind of an environment. So some of the advantages of CLMM, that is the CLMM. Some of the advantages is simplicity. CLMM is quite simple. It's straightforward. Its design and implementations are quite easy and very, very understandable. So whenever you're dealing with a CLMM, you are quite sure to understand what's going on and how to put your money in, how to take your money out, how fees are being generated. So it's nothing hard. It's not complicated. You can just go, even if you're just a beginner, you can actually get a good grasp of it. The other thing is capital efficiency. Of course, all these approaches are capital efficient. So, regardless of whether you're using concentrated liquidity market making or dynamic liquidity market making, you're sure you're sure that your money at one point or another is going to work for you. So your capital is actually being put into good use, and you are ensuring that the trades are quite seamless as compared to when you are using order books. So your capital is working for you. You're happy. You can work while you sleep. The other thing is price transparency. So, see, concentrated liquidity market making tends to use a deterministic pricing formula. Deterministic in a way that you can actually monitor how the prices are changing. So you are sure of what you're being presented is what is actually happening in the real market. So you don't need to have that issue of having uncertainty. So of course, concentrated liquidity market making had its or has its own downside, like the limited flexibility. So in DLMM, in dynamic liquidity market making, we have some flexibility that we did not have before. For example, in DLMM, you can actually provide liquidity with one asset. So let's say you want to provide liquidity in an asset pair of Sol USDC. If you're going to provide liquidity in a Sol USDC pair pool, then you'll need in concentrated liquidity market making, CLMM, you'll need to have both Sol and USDC. There's no shortcut into it. There's nothing you cannot have any shortcut into it. But on DLMM, then if you're going to a pool over Sol USDC, you can decide, you know what, I want to provide Sol alone, I want to provide USDC alone. So there is that flexibility that came in that was not there in CLMM. And also we had the flexibility of market conditions. So CLMM was quite frustrating, but the markets were rapidly changing because you needed to be active in managing your position in a pool, which was quite hectic to a lot of people if you were not entirely focused on looking at the market as hazard is right now. So some limitations were being imposed on liquidity providers with liquidity providers on terms of market flexibility and market changing conditions by CLMM. CLMM also had the issue of capital inefficiency because we are looking at your capital being placed in a specific price range. So if this price range is crossed, or if this price range is not being met by the market conditions, then your money will not be working for you. In DLMM, we have the flexibility of ensuring that the market conditions are adaptable to your capital. So your money is actually working for you full time as compared to as compared to CLMM. The other issue that we had with C or have with CLMM is reduced accessibility. This is majorly focused on the fact that you'll be providing liquidity in a price range that is fixed. So if if markets move past that price range, then it means the feasibility of your money to provide liquidity in the next price range is not there. So that actually leads back to capital inefficiency. On DLLM, the advantages are quite there, and I think I have highlighted them, like the capital efficiency time, because now your money will be moving with the market conditions, which will lead to higher capital efficiency as compared to CLMM, and a better yield generation for liquidity providers. So, well, if you compare pools between the CLMM and the DLMM, then you will find that the yields on CLMM are lower than the yields on DLMM. So the fact that DLMM is moving with the market conditions will make your money to be working for you consistently as compared to CLMM, leading to a more yield, of course, because you'll be capturing a lot of fees as compared to CLMM. DLMM had adaptability. So adaptability is in the sense of the market conditions changing, which is not an issue while you're providing. It's not such an intensive and big issue while you're providing liquidity through the LMM mechanism. We also have the case of increased accessibility when you're using DLMM as compared to when you're using CLMM. So the disadvantages are also there in DLMM. Of course, with advancements come a lot of complexity that newcomers into the market might not be readily in the know-how, as the advancement, the mathematical models, and the increased computational resources that are accustomed to DLMM are there. So if you're new into this field, you might actually want to start with CLMM, get the grasp of how liquidity prevention is working, and then upgrade that to DLMM because they're just building. So DLMM just came to build on CLMM in ensuring that the adaptability is there and quite good. Another disadvantage is price transparency. DLMM being 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 a being a more complex mechanism, then came with a sense of formulas that calculated the pricing mechanism that are not necessarily clear, or they are less transparent compared to the deterministic pricing formula that was being used in CLMM. I believe when we jump into DLMM, I will expand on this because it's quite a challenge. It's quite a challenge that I found while jumping into DLMM when I first encountered it, and I really didn't know how to maneuver it. So I will jump into this point later into the series, and I actually think I have some points that will help newcomers while joining DLMM. The last major disadvantage of DLMM is the potential of vulnerabilities. Of course, we know we are dealing with code, we are dealing with mathematical formulas, we are dealing with computational resources, and that being the case, we actually have these vulnerabilities that might be new. The potential of having new vulnerabilities and risks that are entirely associated with DLMM. But I need to make this clear. As far as I know, we've not had any hacks that are associated with DLMM protocols. The biggest protocol that I've used has actually had no hacks that have been imposed into the protocols due to the fact that they're using DLMM. So that's a kudos in the space. Yes,
Mm.
Hazard, I think I've spoken much. Is there questions that you feel you want to ask?
No, me, I just want to demystify about CLMMs and DLMMs.
Okay,
So,
go on.
just for instance, if you are a, let me say, a reserved trader or someone who doesn't like risking a lot, then
Uh-huh.
I guess CLMM is for you. You
True.
can use CLMM, but if you are daring and you like to adventure a lot,
Uh-huh.
then you can try out DLMM. So if we probably go back to CLMM,
Uh-huh.
I'll maybe give an analogy. If I'm wrong,
Okay.
you'll just correct me. So take for instance, coin X is at $120, and
Uh-huh.
you want to provide, you're a liquidity provider and you want to use CLMM. So as long as the price range that you provided the liquidity is between maybe 120 to 125,
Uh-huh.
you'll keep on earning fees as long as the people trade in that range. And then,
Yeah.
yeah, you as the provider will be given fees.
Yeah.
And then, so the main advantage of that is in case probably there's very volatile market conditions, and
Uh-huh.
the price goes down, and
Uh-huh.
yeah, and you don't really want to associate yourself with it,
Uh-huh.
then you will not be earning fees and your liquidity is safe.
Yeah.
However, if the price maybe goes down or up and it was just constant at 125, that's
Uh-huh.
now where the LMMing comes in. So you
True.
can adjust the range at which you are providing liquidity depending on the market conditions. So maybe you thought it would go down, so you uh, adjusted your price range from 120 to 116, but things didn't go well. It
Yeah.
instead just maintained maybe a slightly higher level.
Yeah.
So, but if things went well,
Uh-huh.
then the DLMMing will just continue earning for you fees.
Yeah.
So, just quick one, CLMMing is for very reserved traders.
Yeah.
DLMMing is daring guys. So, if you go back again to the DLMM, I had a concern on the
Uh-huh.
disadvantage. If you just probably go to the slide of DLMMing on your
Okay.
left, I guess. Yeah,
This was you went on disadvantage.
yeah. So
Okay.
so on the price transparency, what do you mean by transparency? Like the user
Uh,
doesn't know what's happening or what's going on by that.
Oh, okay, okay. So pricing transparency. This one comes in. Let me say according to my experience, this comes in different ways. So the first and the most basic way is the mathematical models and computation behind DLLM price calculation is uh, is quite comprehensive. So if you are new, if you're not good at the mathematical concept of it, you will actually get lost into learning or knowing how they calculate the price movement and calculations and ratios. That's the first and the most basic thing, because
Mm.
we've established that DLMM was built on CLMM, or was built on the theories and the logic that build the CLMM to begin with. So that being the case, of course, you expect that the mathematical models used in a CLMM had to be added onto, or made a little bit different and complex as compared to CLMM. That that triggers the aspect of you wanting to know how the price are being calculated. Might become a little bit of a challenge if you don't have the technical know-how of how things are working in the background. Okay, so that's the first thing that came to me while I was looking at pricing transparency. The other thing that is not entirely based on the protocol that is providing or is ensuring the DLMM activity is the market is moving, and the DLMM is looking to adapt to the market movement. So if you're providing liquidity here, you needed to be able to liquidity. They are ensuring that your liquidity is adapting to the prevailing market conditions. And we all know that the markets will be changing. So you might want to go into a pool in a specific price, but by the moment you want to click or you want to create a position in that pool, uh, within that specific price that you had in mind, then you might find that the price has moved from what you knew or what you you had before to another price which might be higher or lower. So you might actually sign a transaction, or you might actually sign a transaction, but before the transaction goes through for you to create a position, the price would have changed. And in DLMM, it will tick on the price upon signing of a transaction. So you get that you might have that discrepancy. But as we jump into this, as we go into a more hands-on adventure into providing liquidity in one of the best protocols that's provided liquidity for in DLMM and what I use daily, you'll see that the protocols have actually worked a way to ensure that you can have a sort of notification to show you that this price has changed from what you wanted to this price. So you can actually decide to wait for the price to go back to where you want, or you can set a transaction at the current present live price, which has changed. So the pricing transparency might or might not be an issue depending on
Mm.
how you approach this, but it's not something of a concern, such as the potential vulnerabilities. I've just stated it here, but the protocols have done their due diligence in ensuring that what you see in the protocols is what is in the market. So you cannot have a market pricing Sol at 120, and then you go to a protocol and they're pricing Sol at 122. Okay, so you cannot have that one. You cannot have it. So the prices that you'll see in a protocol that you're providing liquidity for are the same prices that you'll see in the real market. So it's not something that should be worrying people. Okay,
Yeah,
but I just wanted to highlight that the mathematical formulas are not the same that you would expect in a CLMM.
yeah, I guess that uh, you've given us spoilers, but I'm pretty excited for the hands-on sesh when we'll be doing them live from next week. So please don't miss
Yeah,
the
yeah, yeah.
sessions. It'll be
It's
pretty
going to be
exciting.
wonderful. It's going to be wonderful, and
Yeah.
if the universe and God allows it, then we might actually have a chance of making some few bucks and giving it back to the people that will be
Remember,
joining us.
not financial advice though.
Not financially advised, though. Yeah,
Yeah.
they have
So
to maintain that one.
I don't know if there's anything else left to say, or since it
Oh,
was an
okay.
intro, we are kind of through.
Okay, so mine is to just tell the audience out there that, especially if you are from where we come from, uh, this is a chance for you people to utilize these opportunities. Uh, blockchain blockchain as a whole was intended to ensure that you come out of the traditional mechanisms of making money or ways of making money, and look for alternatives. And this has been shown by DeFi. DeFi has given you the ability to maneuver past the traditional finance. And as much as you people or the audience have not actually jumped into it, should allow you to jump into it. I'm not saying that development in the space is not good. I'm not saying that other things in the space are not good, but you can actually utilize DeFi as much as you're developing, as much as you're marketing, and as much as you are building something else within the space. So I am looking forward to doing this and ensuring that we teach you the best of our ability and that you acquire a skill that you can use in the long run to ensure your financial flexibility. But but everything we say here is not financial advice, and the markets are very very risky. So you need to have that conscious part of you alert every time. Thank you, Hazard. That's all I had.
Yeah, we are headed to the new frontier of blockchain, crypto, and
Yeah,
fintech. So there's every day there's a new thing happening, uh, like from
true.
CLMM to DLMM, everything. But anyways, that was just a brief intro on this series of liquidity provision that we will be sharing with the whole community. So just remember to, of course, always follow us on our social medias. Oh, by the way, I'll also link DLMM Cook's Telegram handle where we chat a lot about whatever we will be discussing. And yeah, maybe if you want, I want a follow. So follow me at Hazard Crypto on X. Follow DYR Labs on X and Fakasta, and of course on YouTube. So I'll just share the links down here. Maybe Gideon, you can share your handles,
Of
but
course,
I'll
I will
still
share my
share it.
handles, and you can follow me on Twitter. You can join our community on Telegram and on Discord. That's where the juice is. That's where the juice is. That's where the discussions are being held. That's where you find materials, and that's where we have all of this at one place. Just imagine you developing and providing liquidity. Yes, that's it from me. Thank you very much.
Yeah, in fact, through the comms, we can post questions of what you want us to share, or maybe you are like an experienced DLMM guy, so you can also just jump in with a few additions. So, anyway, that's it from us for today. See you next week in the next episode.